PayPal reported its earnings yesterday, and on market open it is nearly 10% down. So is this a fantastic opportunity to buy this undervalued company? Is it a buy now? Let's find out. As always, we'll take a look at the historical performance of PayPal. We'll look at their top line growth given their earnings report. We'll look at their bottom line net income. How well is this performance really looking? We'll look at the balance sheet. Quick health check, total cash versus total debt. We'll also compare their performance versus some others in the industry over the last few years. We'll talk about some insider selling we've seen over the last few months. We'll look towards the institutions after this earnings report in the latest quarter. Are they buying? Are they selling? We'll run through some of their important financial metrics, whether or not it is consistently outperforming. And we will also run through their earnings report to see exactly why this share has been soaring down nearly 10%. And as always, we will run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price, given that margin of safety. And we'll look towards Wall Street to see what they're forecasting over the next 12 months. Now let's take a quick look at their historical performance. So down 24% over the last year. Over the last 10 years, as we can see, it was trading around $35, so it is up, although we do note their all-time highs at around $310 in the summer of 2021, nearly 3 years ago. They're trading at the mid to lower end of the 52-week range with a forward PE just under 12, and we can see the market cap of $68 billion. So let's take a look at their earnings report to understand fully why this has been hammered on market open. So PayPal issues disappointing guidance even as their fourth quarter earnings top estimates. So we can see they did beat on both the earnings as well as the revenue. However, the market did not like that forward guidance, and that is why they have come crumbling down. So let's take a look at their numbers. So we can see the earnings per share 148. It was a beat versus analyst estimates of 136. Revenue 8.03 billion. Again, another significant beat from the analyst estimates of 7.87. So that is nice to see. Their top line also increased 9% versus the previous quarter, which is very, very positive to note. However, we do note the number of active accounts did fall 2% to 426 million, with expectation of 427. So they did also miss in relation to that. Some positive news as well with their bottom line net income. It did rise 52% or equivalent $129 per share. Again, much better than a year earlier where it was 81 cents a share. Now, in terms of their volumes, we can see 409.8 billion for the quarter. Again, up 15% from the prior year and surpassing Wall Street estimates. And one major thing that did send this share price plummeting down was their full year guidance. They anticipate $5.10 per share, significantly lower than analyst targets of $5.48. So overall, in terms of the numbers, top line positive, EPS positive, also bottom line net income looking good. However, their forward guidance has really hit their share price. Wall Street is not liking that. So let's take a look at PayPal in terms of their top line, how they've performed. Now remember, year on year, we want to see 3 to 7% growth, 15.5 billion in 2018, 27.5 in December 22, December 23, 29 billion. So we see those increases consistently year on year, which is always good to see. Nearly 10% in fact consistently. We'll look at the last 10 years as well in terms of percentage format. Bottom line, the story to be told there. 2.1 billion reported in 2018, 2.4 billion in 22, 3.8 billion in 2023, as we mentioned, up 50%. So whilst it has increased over the last 5 to 6 years, we do note the inconsistencies, in fact increasing up to 2020 before staying fairly flat and then decreasing in 22 before increasing. Nonetheless, a very, very strong story there on the top line and bottom line. It does increase over the period, but there are one or two inconsistencies to note. In terms of cash versus total debt for a quick health check, 9.1 billion cash and short-term investments in 2018, 11.5 billion in that latest quarterly report. They do hold a fair amount of cash as well as a much larger amount than they did 5 years ago. Now, in terms of total debt movement, 2 billion in 2018 increased massively to 11 billion. So their debt has gone up, as we can see, nearly 6 times. And we'll talk about the net debt to EBITDA metric shortly too. Now, over the last year, total return, PayPal, negative 31%, the worst performing in the sector. But we do know there are a few in this sector that have been negative in terms of the total return performance. Over the last 5 years, the story to be told there for PayPal, unsurprisingly, given how far they've fallen from that all-time high of $310, we can see they are the worst performing. But again, we do note that it's very mixed in the industry. Some stocks performing very well, some stocks performing not as well. But remember, past performance for PayPal is never an indicator for future performance, and that does and is in fact applicable to the whole industry and companies. Now, a quick look inside the buys, inside the sales. We've looked over the last 3 months for PayPal. Now, what we note, the Chief Strategy Officer, as well as we can see here, Peggy, the Vice President, have sold a number of shares in total, around $4.5 billion. Now, remember, insider selling is never a bearish signal. We always say that just so that you do bear in mind, insiders sell for many reasons, personal or financial. Insider buying, on the other hand, is a bullish signal. What's also interesting to note, from their sell position, the share price has gone up. So let's take a look at institutional ownership. Now, it sits at 68%. Do remember, though, institutional ownership, they do buy and sell quite frequently, as we're about to discover. Over the last 12 months, $11 billion worth of sales by these institutions. In terms of buys over the same period, nearly 3 times as much buying. So we can see institutions do like PayPal. In fact, their largest buy did come in Q2 of 2023. And we note in the latest quarter, Q4 of 2023, a little bit more buying than selling. But please bear in mind, with institutions, whilst this does make up one level of our research, always do your own due diligence. Now, in terms of the financial metrics, let's take a quick look. For those that are new, whilst we have earnings data available, we focus on the free cash flow. Earnings data is susceptible to manipulation by management through accounting, a very, very important fact you need to understand. 132 in 2013, 443 in 2022, going lower to 285 in that most recent report. And as we just ran through, they are looking in the mid to low $5 for their target for 2024. So we can see here it is okay. I mean, it has increased over the last 10 years. Very inconsistent though, year to year. Just be aware of that. If you are happy with that, then by all means, this should be a consideration so far. Now, sales growth, important to note 2 things. One, we like to see a minimum of 3 to 7%. But what is very nice here is the double-digit growth year on year. The only thing I would point out that in the last 2 years, it has dropped to single digits. So we can see that the growth potentially has slowed down. It is something we should keep an eye on moving forwards. But they did have some very strong growth from 2013 to 2021, double-digit pretty consistently. And we note the top line has gone from around 7 billion to 29 billion. Shares outstanding, they do share buybacks, maybe not as consistently as you'd like, but we can see it has reduced from 1.22 billion to 1.12, therefore returning some of that excess cash to shareholders' pockets. ROIC, it is one of my 7 golden dividend metrics. I would like to see a minimum of 10% in the companies I invest. This gives me faith that management are able to effectively allocate their capital, and we can see pretty consistently around that 10% or more. So I do quite like that when looking and analysing at management as part of the investment thesis. Operating margin, very nice, consistently around 16%. Free cash flow margin, it has started to decrease over the longer period. A massive drop in 2023. Now, while 7% is our minimum target, it is above that, but maybe something just to keep an eye on moving forwards to ensure it doesn't continue to decline. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us that balance sheet strength, and what this number indicates is that it would take the company 0.1 of a year to pay off all of their debt net of cash on hand. We want to see a minimum of 1.5, so this is very positive. In fact, in 2023, it wouldn't even take them 1 day to pay off all of their debt, so they have a very strong balance sheet. So let's jump into the valuation, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model. Now, typically, we use the Graham's valuation as the first model, so we have the earnings per share, the stock ticker symbol, in fact, the long-term growth rate, the corporate bond yield, to get an intrinsic value of $82. So we have our first signal of undervaluation. Bear in mind, though, we don't look at any of these models in isolation. We then have the multiples valuation, companies in a similar sector and size and outlook. We have the average P multiplied by that of PayPal to get an intrinsic value of $120. Again, another sign of undervaluation. We then move on to what would typically be the third model, dividend discount model. However, PayPal do not currently pay a dividend. So we move on to the DCF model. We have the free cash flows year on year, average growth rate. We have gone with a lot lower than analyst estimates to be a lot more conservative, and we do note that potentially this will start to slow down year on year. In conjunction with the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get an intrinsic value of $92. So we had three signals here of undervaluation, and don't forget you can grab a copy of this valuation model to get to both the intrinsic value as well as that acceptable buy price of companies in your own portfolio or those on your watch list. So we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see if we believe that it is a buy up to $88. 15%, $83, and we pretty much keep going until we get to around the current trading price. And as we can see here, for PayPal, there is some significant margin of safety. And when we look at around 40%, it is pretty much bang on the current trading price. So based on our estimates and judgments for PayPal, we see a 40% margin of safety. In terms of Wall Street, well, they have a price target now which was lowered since their earnings to $71.45. So they do still see nice upside around 23%, and they do see this as a buy. As always, do let me know your thoughts in the comments below whether or not this is one you are looking to add or maybe have added. For me personally, PayPal isn't a stock that I want to be adding to my portfolio. In terms of those long prospect growths, I just do not see this being a very strong contender in relation to some of their competitors and in this industry and space. As always, have a great day. If you enjoyed the episode, smash that like button, hit the subscribe and bell button, and as always, have a great day, and we'll see you on the next one.